Welcome everyone to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe, and for those of you that do, thanks for checking me out again. As always, you can check me out on social media at EveryTimeICash, or you could reach out to me directly on my website, everytimeICash.com/contact. This video and videos like this are intended for informational, educational, and entertainment purposes only, and they're not to be substituted as financial advice. If you're looking for financial advice, please seek the help of a financial professional. Please seek the help of a financial advisor so they can help you build a plan that better suits your needs. This is going to be a video about something that I've kind of been paying attention to lately, and it's something that I want to just kind of go over. I know that I have a little bit of a reputation online as someone who might hate Cathie Wood, and I have nothing against her. I just don't like the evangelical cult following that some of these people get and some of these things get when it comes to stocks. So, like, if you say something negative about ARK, you say something negative about Cathie Wood, and it's not even negative about them, it's just about a position that they have, you're constantly bashed. And I think that that's kind of like a dangerous thing. So I just want to make a video about some of the thoughts behind that, some of the things that I've seen. And primarily, I wanted to make a video about this because of what we just saw recently with ARKK and Bill Huang. So I'm not going to take up too much of your time. This is going to be a really quick video. So without further ado, I'm just going to jump right in. So if you're watching this, and there's an audio version of this on my podcast feed, but I really recommend that you check out the video version. But if you're watching this on your screen, you just see the problem with ARK: has Cathie lost her touch? So that's just obviously like a little bit of a clickbait title, a little bit of a just sensationalism. And I'm not going to be here to tell you whether or not she's lost her touch forever, whether or not that was a one-trick pony. I'm not going to be that guy. But I will say that historically, things like this and behavior like this doesn't end well. And that's kind of where I want to start. But first and foremost, for what we remember about stocks in general, the market is a feedback loop, right? So on the way up, this feedback loop and this notoriety and these positive sentiments and this Midas touch that people have really favor whatever positions that these individuals or that these hedge funds have. And this is something that Cathie was a benefactor of last year. So being the golden child, saying Tesla's going to go to 3,000, and it ultimately getting to that price target, no one wants to step in and say, wait a minute, are we going too far too fast? Are things setting up for disaster? Is this something that we should pay attention to? But we are in a situation right now in the market in general where it does kind of require us to proactively take these precautions or proactively take these assumptions or thoughts in advance of something happening. So you don't want to be the person that just kind of has the knee-jerk reaction after the fact, because then you can kind of tailspin and find yourself chasing. So it's good to have these thought experiments and these thought exercises before things happen. So again, the market is a feedback loop. So on the way up, things are good, but on the way down, things are violent and they're nasty. And we saw this firsthand with Bill Huang and ARKK, with Viacom and with Discovery and whatnot. So I'm gonna just pull up a chart here real quick just to show you in case you don't recall. But by and large, this dude levered his positions like 5x. And was levered. They still don't know how much he had on the books, and single-handedly basically pushed this stock Viacom, along with others to extreme. So pushed the stock up to 100, and in a matter of like 2 weeks, the stock was trading back to 40. In a matter of 2 days, actually, the stock was trading back to 40, but essentially in a matter of 2 weeks, and it's not really recovered since. So it's important to note these kinds of things and to see these exogenous events so that you can prep for them in positions that you may have, right? And in the case of Cathie and in the case of ARK, historically, we know that this type of behavior has never worked. So the primary issue that I have with ARK and with Cathie and the cult is I constantly hear that this individual is setting up for a 5, 10, 15, 20-year plan. And that's fine. I'm not going to be here. I'm not going to sit here and be the guy that tells you that I know better than people who may know better than me. But what I can say is if you are looking for a 5, 10, 15, 20-year plan, the idea that you're actively managing something on a day in and day out basis is kind of silly. And it's beyond kind of, it's actually just silly. So to hear that, we're holding Tesla for the next 10 years and to see someone like trade around it as actively as I see people trade around it, it's kind of foolish, and it's kind of a fool's game in some sense. Any and every active or passive investor for long-term growth that I've ever encountered does it on a slow, steady, consistent basis. And I understand that in the case of Cathie, she does have her positions and her core positions. I'm going to pull them up here for you. So they do have their core positions and they trade around these positions. But the primary example that I can give you is just going to be Coinbase, right? So Coinbase is the 13th most heavily concentrated position in ARK Innovation Fund. That's ARKK. And if you just pull up Coin, IPO'd, hit 430 basically, and it's just been in a nosedive ever since. And fundamentally, when you think about it, you would think that with more and more people getting more and more active with crypto and more engagement on this platform, that this is something that could work in the long run. But to see a little bit of reckless abandon on a day in and day out basis by ARK, going in and buying Coin after they IPO, immediately after they IPO, over and over and over again, there is no situation where they're not underwater right now. Given that it hit a 430 high and then today hit basically sub 270. So these kinds of situations are dangerous for people at home to replicate, because they being people at home don't necessarily have the bankroll to position themselves for constantly buying the dip. At some point you run out of money, and at some point you need the stock to move in your favor. You need the portfolio to move in your favor. So this is really important, and it's really an important barometer and an important lesson to have in the back of your mind, so that you don't try to replicate some of these things that you see people do on a day in and day out basis. The second thing that I want to kind of call to attention is that the S&P in general has kind of showed a little bit of signs of slowing down. And so on the surface, it's not much of a give back. It's not much at all. We've held the 20-day, yada, yada, yada. So on the surface, I'm not saying it's a bearish thing. I'm not saying it's an exogenous event. I'm not saying any of that. But I am saying that when things slow down, it's important to kind of note and to pay attention to what it is that lags, right? So when you pull up the NASDAQ's actually lagging more than the S&P. And primarily, if you're just to pull up, I'm going to pull up her list again. You just pull up all of these names, right? So let's just go through the first five. So you have Tesla, dead money. You have Square, dead money. You have, what was the other ones? Teladoc and Roku. Teladoc, dead money. Roku, dead money. And Shopify, Zillow. Let's just pull up those real quick. So Shop, dead money. Zillow, dead money. So the issue here for ARK in general, and for having a portfolio like this or positions like this, is the more that your primary position, so the more that these positions at the top start to struggle, the more difficult it will be to offset these losses, right? So if you have core positions and they're like Zillow and Tesla and Square and Roku, and these positions start to flounder, at some point you have to make decisions about these positions. You have to decide whether or not you're going to hold them or whether or not you're going to fold them, right? So in this case, and in ARK's case, when you pull up their performance and on your screen you can see it. These are based on her list. These are the top 15 names. Tesla's down basically 5%, Teladoc 21%, Roku 4% basically, and the most extreme case is which is down 38%. So when you compare that with the only three names in those top 15 that are up, it shows you just how imbalanced to the downside this actually is. And so that kind of creates a little bit of a chase mechanism, and it creates kind of like a feedback loop, right? So as these positions start to flounder more and more, and there isn't that one solid staple position that you just don't have to worry about, the more it will require constant maintenance or constant chasing or constant performance editing so that you could try to offset these losses, right? And so the secondary thing behind this, or the second thing about this, is a lot of her positions, or a lot of the positions in ARK in general, overlap. So there's a big Bitcoin thesis, right? So, if Bitcoin starts to do poorly, well, if you just start to go through the list, you see Tesla's associated with Bitcoin, you see Square's associated with Bitcoin, and you start to see that there are, and then you see Coin is associated with Bitcoin. So you start to see that there are relationships that could weigh on the portfolio in general, right? So you start to see that there are situations where these different positions won't act independent of one another. And that's a really dangerous game when things start to go against the grain. The second thing is, if you pay attention, and I highlighted this here below, if you pay attention across all of the funds that ARK had, they had basically $47 billion by the end of March. This number is down from a $60 billion peak. So unlike hedge funds and unlike traditional funds, when you have ETFs, there's no window where you lock people from being able to sell their ETFs. So this adds to that feedback loop that I talked about, where the moment that people get tired of this fund or get tired of the positions, and they start to say, hey, well, wait a minute, the S&P's up 8% or 12% on the year, and I'm down in these funds. Why am I holding this and not holding, like, Caterpillar, let's say, or Goldman, let's say, which made all-time highs today? So this psychology for individual investors and for investors in general may start to play out and kind of force the hand for ARK as they start to lose more and more money, which kind of makes it more difficult for them to offset some of these losses. So if you start losing money when you have $60 billion and that money kind of sits on those losses kind of sit on your book, well, when you start having 40 billion or 50 billion, now you just need to amplify those gains, that much more in order to offset those losses. And then the final thing is, people generally, don't. It's very easy for people to say, I have a 5-year horizon, but they don't necessarily calculate when and where they'll need that money or how they'll need that money. So it may well end up working out for her in the sense that, her money and her fund's money and people who ride this out with her for the next 10 years works out. But it's a dangerous game in the middle of it, where you start to see these wild swings and you start to see this asymmetric risk to the downside. And I'm just talking about like Spotify down 24% or Udemy down 38% or CRISPR down 25%. You start to see these losses just kind of mount up, and it creates these instances in which individual investors or investors at home who try to replicate or who think that they have a tolerance that this individual might have find out that they don't necessarily have the same risk tolerance. So the last thing I'm going to leave with is Tesla is the saving grace for this name, right? So I just went over a list of the list of performance in this fund, and I just showed you the top 15 names. They're on your screen right now. You can pause and take a look at it yourself. Tesla is down 4.5%, but honestly, that's just basically 2 hours, right? So the more of these names that start to underperform, the more it will require, whether it's averaging down or selling something else to buy into positions, which is something that they like to do at ARK. And they could very easily do it from the bottom names. I understand that. They just recently changed one of their call it rules in their ETF, where they basically said, we're not going to cap our exposure to 10% per name. So they're going to have an ability to go in there and say, we want to have 20% exposed to X name, right? So in the case of Tesla, as long as Tesla is able to hold that line, it really buys them a little bit of time. The moment that we start to see Tesla flounder, and so I'm just going to pull up Tesla real quick. the moment that we start to see Tesla flounder, which is it's basically gone nowhere. And you have these wild swings, you have these moments where they take off and they get sold, whatever. Essentially, your line in the sand for Tesla this year has been the 150 day. So, the Cathie bottom originally was the 100 day. It was here. It was February 23rd. Then we got the 150 day save here, another 150 day save here, and we're just having trouble with this name to really breaking out above this downtrend. And we're going to find ourselves in a situation where this pretty big wedge kind of resolves potentially, and this 150 day gets tested. Now, if this 150 day gets broken and you have other names that are not performing in that fund, it's going to get ugly, and it's going to get ugly real quick. And this is not an opinion of me disliking someone or wanting to see it happen. This is just basic math. When people, like I said, people often have an optimistic perspective when they say they're going to hold something for 5 years, then they find themselves in a situation where that 5 years is not going to be able to happen, and they need that money, and they need it right now. So Tesla is something that you want to pay attention to, and if this doesn't hold up any longer, then you're going to start seeing not only some violence in these names, but you may possibly see some raids in these names as well, which is not different than what we saw in Viacom, with what we saw in Baidu, with what we saw in Discovery. It's not that different. Obviously, it's not going to be as aggressive because it's not levered like he was. But when you start to see a lack of participation, you start to see a lack of follow through. You start to see a lack of upside, and at that point, this individual in this fund is going to have to consider whether or not the positions they have are indeed going to work out, or they are going to be held on their books, or if they have to reassess. So this is just something I wanted to bring to people's attention, something that I've been thinking about, and I think it's really important. And with that, I want to say thank you. I want to say thanks for your time. Thanks for checking me out. As always, please stay safe, please stay profitable, and please stay locked in.